Now let us go ahead and take on this example on capital asset pricing model. Now you would have learned about beta asset formula and then how to calculate the risk premium and so on and so forth. Now let us take on this example. Yes, Renuka.
XYZ Limited pays no taxes and it's entirely financed by equity shares.
Two things. You don't pay any taxes and also all equity finance. That means your company is not, it is unlevered and does not employ any debt funds. Next.
The equity share has a beta of 0.6 and a price earnings ratio of 12.5.
Okay.
And is priced to offer an expected return of 20%.
So here there is a small mistake in the question. It is given that the asset, that is equity beta 0.6. Now, because a firm is all equity financed, the risk that is related to the assets employed will also be the risk of equity, that is a beta equity. Now, for an all equity finance company, please remember the beta equity will be equal to the beta asset. Suppose you have rupees 100 investment in the company's assets. All the rupees 100 is contributed by the equity shareholders. Therefore, you can say that the risk of equity is also the risk of the asset. That is a beta asset. Agreed. And then the price earnings ratio, they should have given not 12.5, should have been how many times? Should be 5 times. Please make a correction. It should be 5 times. It is a mistake in the question paper itself. Fine.
Yes.
And then the third point given is, it is given the shares are priced in such a way that the earnings available to the shareholders is 20%. That means, suppose a market price is 1 rupee. Now, what is 20% on rupee 1? 0.2. 20 paise is your earnings per share. Now, you know that earnings per share 0.2 upon 1 rupee market price into 100 is 20%. That is a return on the equity, right?
Yes.
That is based on market value. Now, just see the other way around. Suppose you put the market price on top, 1 rupee, divided by EPS 0.2, that is earnings per share, you should get your price earnings ratio. Market price by EPS. So, what is 1 rupee upon 0.2? It will be 5 times and not 12.5 times. Is that clear?
Yes, sir.
The price. Next.
XYZ Limited now decides to buy back half of its equity shares by borrowing an equal amount.
That means, yes.
If the debt yields a risk-free return of 10%, calculate.
Wait, it's given that you decide to buy back out of rupees 100 equity funds. You want to buy rupees 50 by taking a loan. That means after buyback, you will have rupees 50 worth of equity and the balance of 50 will be debt funds. Remember, the total assets in the business will not change. It's going to be rupees 100. Of that 100, 50 rupees will be funded by equity shareholders after buyback. And the balance rupees 50 will be debt funds that carry 10% rate of interest, right?
Yes.
It's going 10%?
Yes.
Okay, then.
Calculate number 1, the beta of equity shares after the buyback.
It is given calculate the beta of equity after buyback. Next, number 2.
Number 2, the required return and risk premium on the equity shares before the buyback.
Before buyback, what is the required rate of return? And also find the risk premium, which is RM minus RF. Next.
Then the required return and risk premium on the equity shares after the buyback.
After buyback, what will be the required rate of return on equity? And also calculate the risk premium. Next.
Next, number 4, the required return on debt.
Okay, next.
Number 5, the percentage increase in expected earnings per share.
Okay, calculate the percentage increase in earnings per share.
Number 6 is new price earnings multiple.
Also find the price earnings ratio, the price earnings multiple.
Assume that the operating profit of the firm is expected to remain constant in perpetuity.
Okay.
That's it.
And for debt, what is given? They're going to replace that buyback part. Read that part. The company half.
XYZ Limited now decides to buy back half of the equity shares by borrowing an equal amount. If the debt yields a risk-free rate at 10%, calculate.
That means basically the rate of interest on your loan is 10%, which is also the risk-free rate. Point to note. Is that fine? So now we shall go ahead and take on the questions one by one. This is a possible MCQ, right? Now what is the first question? Find the beta equity after buyback. Now you all know this formula, or you should know this formula. Beta asset equals what? It is a beta equity. That into E by E plus
D.
it should have been D into 1 minus T. But since no tax, therefore ignore the tax saving, right? The tax rate plus beta debt into, it is a debt by debt plus equity. Is that fine? It should have been a debt into 1 minus T because a tax rate is not applicable for this company, right? They live in a no tax world, not an issue. Now we know the beta asset, which is nothing but the beta equity given for the unlevered firm of 0.6, right?
Yeah.
That equals beta equity we don't know, but that into, we know equity and debt is going to be half, right? Equal.
Yeah, 50%.
So 50%, so 0.5 divided by 0.5 plus 0.5, basically 1. Or you can take 50 rupees upon 50 plus 50, right? 50 by 100 plus nothing given, beta debt is taken as 0 because they also given where the debt is risk free. Fine. So 0 is a beta debt, that into 0.5 by 1 or 50 by 100. Now when I solve this, how much I get beta equity? Works out to 1.2. You know, the beta goes from 0.6 to 1.2 because of financial leverage. Because your company is going to employ debt, the beta equity, that is a risk, the shareholders' risk will increase from 0.6 to 1.2. Is that clear? That part is fine. Next question. Find the required rate of return and the risk premium before buyback. In fact, the required return is nothing but, remember, it is a 20% given. It is given, right?
Yeah.
It is given that the shares are priced in such a way that persons investing in your company before buyback will get a 20% return on the money invested. So that will be the expected or required rate of return. And here you can assume that the shares are fairly priced. Therefore, the return, the 20% is a CAPM return as well. Is that fine?
Yes.
So we write down this formula. What is that? CAPM return formula. 20% equals, what is RF?
10%.
We know 10% plus, what is a beta?
0.6.
0.6. We know beta equity before buyback. That into RM we don't know. Minus RF we know 10%, right?
Yes.
Close brackets. Now when I solve this step by step, I get RM how much?
26.67.
Exactly. But I want the market risk premium, MRP, which is RM minus RF. So 26.67 minus 10, it is 16.67% is your market risk premium. Is that clear? Now with that we complete the second part of the question, right? Seconds are over. Then what is the third one? Find the required rate of return and risk premium
after buyback.
post buyback. Here you got to understand one thing. Remember, the 20% return doesn't change. I'll tell you why. Just see the two can you show the handwritten?
Yeah.
The balance sheet. Guys, just check this, okay? We know that before buyback, we have assets worth rupees 100 in the company, and all the 100 is equity funded, right?
Yes, sir.
Now, right now, what is the earnings of the company? The company earns 20% on rupees 100, how much? Rupees 20. And that is a profit earned by the company before buyback, 20%. Because the asset is, you have invested your money in such a business where you get a 20% return on the assets employed. Just see after buyback the balance sheet. So still assets are how much? Are worth 100. You will still earn rupees 20 on your asset. That won't change unless you change your business, right? But not all the 20 rupees will go to whom? Shareholders. The reason is, just see the balance sheet other side. Equity how much? 50 rupees. And debt how much? 50, and that carries 10% interest. Guys, take a calculator. What is 20% on 100? You will still earn rupees 20 on your funds employed. Is that fine? You'll earn 20 rupees. So that minus 5 rupees interest, 10% on 50. So what is the net on 15 rupees will be the profit available to shareholders. Now what is 15 rupees upon 50 rupees equity funds into 100? 30% will be the return that can be expected by shareholders, and that is a return they want given the capital structure. Is that fine? Please remember, whenever the company employs debt, the return on the asset cannot change. In other words, the WACC will not change. If there is no tax involved, anyway the WACC will never change, because anyway there is no tax benefit on additional debt. Fine.
Yes.
So the WACC will not change. What is WACC? The weighted average cost of capital, or I can say that is the return on the assets employed. People ask me how? Very simple. The return expected by shareholders becomes company's cost. For example, the return expected by the landlord becomes what? The cost to the tenant. The return expected by the banker on the loan becomes what? Cost to the borrower. Yes or no? So having that logic in mind, please understand this. The return on the asset 20% will not change, but the return expected by shareholders will increase because of financial leverage, because risk is high, right, when you employ debt. Just see the calculation, that is the printed solution now. Okay, so just see return on asset, right? Return on asset is equal to what is given?
So return on equity into E by E plus D plus return on debt into D by D plus
When I say return on equity means a required rate of return, the return expected by shareholders. Okay, you can do this and find 30%. How? Left hand side how much? It's going to be 0.2 or 20%, right? That is equal to the return on equity expected is, we don't know, that into 50 by 100 or 0.5. Am I right?
Yes, sir.
Plus, what is the return expected by debt holders? 10% is the rate of interest they want, yield, right?
Yeah.
10%, that into again 50 by 100. Debt by E plus D, right? Nothing but the formula for the WACC. Can we have the formula for WACC? Just see the formula. This WACC is nothing but the return expected on the asset, because that becomes a company's. The return required by investors in the company becomes company's cost. Yes or no? Therefore, cost of capital K naught or KO or WACC equals KE. We are trying to find out. That into 50 by 100 plus, we know KD is how much? 10% into 50 by 100. Is that fine?
Yes.
Now, when I solve, how much I get?
30%.
I get 30% as a required return expected by the equity shareholders. Is that clear? And then don't bother to find the risk premium once again. That can't change, right? Your RM minus RF will not change. Or if you want, if you don't trust, you can check it out. Have they done that? It is 30% equals,
Yeah.
right? RF 10 plus
1.2 beta.
1.2 into RM minus
10.
10. Again find RM, you will get 26.67.
67.
And what is the premium? That minus
16.67.
RF. Same. It won't change, right? And then now we go to the next subdivision. What is that?
Required rate of return on debt.
Very simple. We know already given 10%, right? No tax also. So 10% is your return expected by the debt holders. Next.
The percentage increase in EPS has been calculated.
Now what he has done, he has made a nice, just see the table. So particulars before buyback and
After buyback.
after buyback. Now first line,
Equity.
let's assume that there are 100 shares and market price. This is a market value balance sheet, okay? Based on market. So 100 rupees, 100 shares into 1 rupee per share 100. And what was post buyback? 50 shares of 1 rupee, 50. Got it? And how much 10% loan? 0 and 50. What are the total funds employed? 100 and 100. Balance sheet, right? This is basically the balance sheet. Next.
EBIT at
Is nothing but at 20. It doesn't matter whether you have debt, whether the buyback or debt or not. Okay, pre or post buyback. 20% is a return on the assets employed, right?
Yes.
How much? 20 rupees?
And 20.
And 20 rupees. But minus interest will be 0 and 10% of 50, how much? 5 rupees. So what is a profit before tax? It is a 20 and 15. Income tax anyway?
Nil.
0. How nice. Okay. And what is the profit available to shareholders? 20 rupees and
15 rupees.
15 rupees. Next line.
Number of shares is 100 and 50.
100 shares and 50 shares, right?
So earnings per share will become
It is a
0.2
20 paise.
and
20 paise per share and
30.
30 paise per share. Next.
And the P ratio 5.
Very simple. We know that it's market price by EPS. What is the market price we assume?
1.
1 rupee, right? So what is 1 rupee by 0.2 EPS? Is 5
It's
times.
5 times.
And here what is 1 rupee by 0.3 EPS?
3.3.
3.33 times. Then we haven't answered one question. That is find the return.
On equity.
That is
20%,
already found
30%.
anyway, 30%, right? 20% and
30%.
that is fine. But I want to find the percentage increase in EPS, right? Have they done that?
Yeah.
We know 0.2 is EPS before buyback. After 0.3 EPS. What is the increase? 10 paise, right? So 0.1 divided by 0.2
2 into
100. There is a 50% increase in earnings per share. Is that fine?
Yes, sir.
So guys, I learned the sum really well. Possible MCQ.
The last question. New price earnings multiple.
Oh, that's for the price. It's already there in the table. We know the P ratios what they are 3.33. Already there in the table. That's why I didn't take it up. Okay, because it's already there in the table 5 times and 3.33 times. It's there in the table itself, right? It's there in the chart.
Yes, sir.
So no problem. So guys, this sum is really important from examination standpoint. Learn this really well. It's a very old CA final examination question, right? Have they marked it CA final any year given? In the question, have they given?
In the question, it is marked as CA final May 2002.
May 2002. Okay. So this sum should be older than you people, right? So guys, anyway, so please treat the sum with a lot of respect and work it out. Bye-bye.